So hello, this would be our first discussion video for Management Accounting and Control, and this would be for Module 1, Introduction to Management Accounting and Control. So in here, we will introduce the concept of Management Accounting and the difference that it has from the other fields of accounting that we have right now. So when we do accounting, like financial accounting, we expect to have an output that is the standard set of financial reports, which is composed of the statement of financial position, comprehensive income, changes in equity, and cash flows, with the corresponding notes. So however, here, what we get is actually this, the standard set of report, but in the company, when we decide, we actually require more than what is presented in the financial reports that we create as a result of financial accounting. So this is what we actually need. That is why we have this area of accounting where we are trained to create customized reports that the management or those who are in charge of decision making needs for the furtherance of the organization. That is where the field of management accounting comes through. So management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation, and communication of financial information. That portion is intended for accounting, and its difference against all other areas of accounting is it is used by management to plan, evaluate, and control activities within an organization. Generally, accounting means the data accumulation process, and the purpose of that data accumulation process is what differs this field of accounting from other fields of accounting. So what is the difference of management accounting across all other fields of accounting? So in here, let us compare management accounting with financial and cost accounting. What is financial accounting? So there we go. It involves recording of business transactions, which is governed by a body of financial reporting standards, leading to preparation of financial statements that are for use of various interested parties, internal as well as external. While management accounting is concerned with providing financial information to individuals within the organization for them to have and make informed judgments and to decide for the company. So our goal in management accounting is to have that information to be provided to the decision makers or the key personnel of the organization, so that they would have informed decision making processes. While cost accounting actually is a systematic set of procedures for recording and reporting measurements of costs of manufacturing goods and performing services in the aggregate and in detail. So cost accounting actually is a data accumulation set of accounting in which this information actually is used on other fields of accounting like financial accounting as well as management accounting. There are certain areas of cost accounting where they are concerned with financial accounting, while certain areas are concerned with management accounting. The cost information that we acquire from cost accounting is relevant across all fields of accounting. So in here, we would have a comparison of financial and management accounting. So as to objective, what is the objective of financial accounting? It is to provide data for both external and internal users. And management accounting, the emphasis here is it is primarily for internal users. So can't we provide the management accounting reports to external users? We may, if we intend to do so. Are there certain reports from management accounting point of view that are provided to external users? Yes, like projections. Projections are generally for management accounting use, but when we are going to loan and the bank needs a foresight of what the company will be in the next 5 years, we are providing projections. And we use management accounting techniques to be able to reach those projections or assumptions. While financial accounting information, the reports for financial accounting are general purpose reports that we prepare according to the standards and are available for use for the general public and all stakeholders thereof. As to compliance with the International Financial Reporting Standards or the Philippine Financial Reporting Standards, which is the counterpart of IFRS in our country, financial accounting requires for the compliance on these standards. So, if we are going to prepare the statements for financial accounting purposes, they should have been in compliance with the standards. While for management accounting, mandatory compliance is not required. So the management accounting reports does not necessarily comply with these standards. But how do they become reports as they are? We actually follow a certain system in which we develop the reports based on the need that arises in the organization. So if the report is required to be presented in cash basis, then we need to present it in cash basis to determine whether the company is liquid and whatnot. And then we also have reports here that are presented not in accordance with the definition of product costs and period costs. So there are reports like in cost reports wherein overhead costs are carried on with the product, but there are certain costs there like depreciation that are not attributed to the product when it comes to variable costing, which is a management accounting perspective. That is a useful technique if we will utilize it when it comes to maximization of resources and determining the profitability of the product that we are selling. So that is not in accordance with IFRS, because IFRS requires that all costs, whether direct or indirect, incurred in accordance with the production of a unit that we are intending to sell, unit of inventory, then it must be carried along with that inventory. So it should be capitalized with that inventory. So if the inventory is still unsold as of the end of the period, the fixed depreciation costs associated with that product shall be included as inventory. Well, for variable costing purposes, we do not do that. We expense such item outright, which is not allowed in the standards. Time period. For financial accounting, the focus is historical. Why do we focus on the historical orientation of financial accounting? In financial accounting, we focus on what has happened and how to document what has happened. While for management accounting, the purpose is for us to provide information to be able to assist the decision makers for the future of the organization. So the financial accounting has strong historical orientation because the focus is compliance, while the management accounting information, the focus is on future, because our goal here is to provide information for decisions of the organization. Because it is more important for management accounting information to be provided on a timely manner, which is another item here in the difference of financial accounting and management accounting. For the use of information, financial accounting information is pro forma. It can be used by different parties for various purposes. As long as it complies with the IFRS, the reports are presented as is, and we use those reports for various various purposes. So everyone and anyone can look at them and can interpret them as it is, because there is a unified standard that is being followed by that report. While management accounting is on a needs basis, so it should meet the specific need of the user. That is why it is prepared in accordance with their demands and whatever they need to see in a report. So it is to be noted here that management accounting reports should be furnished to those who actually require it or need it, because those reports might be misconstrued by other parties which actually do not need them but get a hold of that report, because if they do not know the underlying concepts behind the report, they might not understand it as it is. So emphasis of report. So the emphasis on financial accounting is precision, compliance with the standards, while in management accounting, the focus is timeliness, that is provision of the report on time. Because when such report is provided at another time, then it might not be relevant anymore. So it is to be noted here that financial accounting reports may be given at a later time as long as they are in compliance with this standard. While management accounting reports, the focus is, even if we do not have precise information in the report, the focus here is we need to provide the report as soon as it is needed. So, does it mean that it is okay to make mistakes in management accounting reports? No. What it means here is that we are allowed to use estimates and projections for management accounting reports, wherein financial accounting reports does not allow that. What is the perfect example of that? Standard costing. So, at times when we need costing estimates, costing details for products, if we need them right now, if we do not have yet the complete set of reports for the cost of the product that we are making, we usually use the standard cost information to provide data to the decision makers as to the cost of the product that we are producing. Well, in financial accounting, it is not required. It's not allowed for us to use the standard cost as the basis for the cost of the products that we are actually selling. We need to reflect in the cost of goods sold the actual costs incurred. If you would remember using standard costing, right? We actually account for the variance and we record them under cost of goods sold for those actually sold, and all others on the inventory and to the related accounts to which they should pertain. Reporting requirements. So the financial accounting reports are presented for the company as a whole. So the reports for company X, that is it. That's the reports for the company X. While in management accounting, reports are presented as segmented as possible. Why? Because the more detailed the report is, or the more it dwells into a specific segment, the more it increases its value, because it increases the information that it provides. Also, management accounting reports are segmented in nature because they promote responsibility across teams. Compliance with the law. Of course, financial accounting requires compliance to the law, while management accounting reports are not necessarily required to comply with laws and regulations as well as standards.